Welcome to the latest in the Merchant Health Check series. As part of NMBS's ongoing commitment to helping its members, Merchant Health Check series has been devised by Moorgate to provide NMBS members with some top tips to help merchant owners look at ways to grow and develop their business based on the Moorgate team's own experience. These bite-sized webinars will focus on important elements within your business, so by the end of each webinar, they will hopefully have provided some key takeaways for you to use within your business. The first of these is centered around credit management. So looking first at what is credit management. It's defined as the process of setting and reviewing your credit policy, evaluating customers and granting credit, then setting the terms on which it's granted to customers. It's then about monitoring how this credit is used, recovering this credit when it's due by collecting payments on time, managing the credit risk of late payments, and initiating recovery proceedings when it's past due. More importantly, it's an important part of your sales process and ultimately helps your business maintain a healthy cash flow, reduce bad debt, and maintain financial stability. In terms of improving credit management, this webinar will focus on setting and reviewing your credit policy, evaluating customers and granting credit, setting customer credit terms, monitoring how credit is used, collecting customer payments on time, managing the credit risk of late payments, and managing recovery proceedings when past due. So looking at the first of these, setting and reviewing your credit policy. If you haven't already set your credit policy, being simply a set of guidelines your business uses to manage the process of giving credit to customers, following areas may be worth considering to include. Firstly, terms and conditions. Do these actually reflect and protect you when offering credit, and when were they last reviewed? Credit worthiness. How are you going to look to evaluate your customers' credit worthiness or the risk assessment on them? What credit to offer. How to determine what credit you will offer your customers, i.e. credit limits. How you want to be paid. What payment methods you want to use. What your risk appetite is regarding additional protection, i.e. do you want credit insurance and or look at personal guarantees from customers. Processes you want to use. Deciding what your processes are, such as account opening, credit limit setting, chasing and recovery, as well as the forms to use, such as application forms, credit increase request forms. And finally, documenting, communicating and training. How are you going to document these processes? Where will they be kept? In your ERP or CRM? And how will you share these and train your colleagues on them? Once you've completed these, it's helpful to review them with your team on a regular basis to ensure they reflect what's actually happening and update your documentation. And crucially, communicate to your colleagues, either written, by email or using intranets if you have them, or more successfully verbally within sort of stand-up team updates or within your regular branch roadshows. Looking at evaluating customers and granting credit. To assess the credit worthiness of potential customers, following considerations are key. Firstly, credit application forms. These typically include a range of information needed to assess their credit worthiness, including basic company information, so things like legal entity name, registered office and registered number if a limited company or partnership, and more personal information if a sole trader. Secondly, who owns the business. Includes the shareholders and persons of significant control noted at Companies House, as well as the directors who run the business day to day. Difference being there between shareholders and directors. What their financial position is. Typically this is both published financial information available at Companies House, as well as management information, which won't be things like latest management accounts to help you understand trends. Trade references will often be included. These are typically their main materials suppliers who are happy to act as references regarding their credit standing. Personal guarantees, often requested in circumstances where financial information does not support the credit required. And verification of identity in terms of know your client, so usually done manually or in branch. Variety of formats are used for these application forms, whether paper, online, in person at the branch, and time taken to process can vary significantly. Opportunities using technology to automate this process for instance, in terms of verification of identity, can mean that the opportunity for them to spend sooner in your branch through granting credit can take place. Looking at the granting of credit, the evaluation of this credit application form is usually done using credit analysis tools, whether they be external credit agency reports or credit insurer portals. Will often include the following considerations. Performing a thorough analysis, usually done by your own team, using the information collected from the credit application form will allow you to evaluate their credit worthiness. And there's a couple of things or tools that are used for this. First one is from the information provided, looking and evaluated the 3 C's. These are character, so the applicant's previous financial track record regarding how they've dealt with debt and repaying it. Second C is capacity, refers to the applicant's ability to repay, usually seen from the profitability from their financials as an indicator. And third C is capital, their investment in the business with assets from their financials being an indicator. Credit reports and insurance, these will provide you with an external validation of the information the applicant has provided, often along with a suggested credit limit, and these are a prerequisite clearly for credit insurance. And references, actually speaking to the references wherever possible, will help establish the relationship and behaviour. Based upon this analysis, the application will then either be approved or denied, or further information required, maybe with a site visit to meet the applicant is recommended wherever possible. Having evaluated and decided to give credit, the terms upon which you want to give them credit will be subject to several considerations. Firstly, the credit limits. So credit reports and/or credit insurance provider portals often dictate what credit limit can be set that they will cover by insurance. Clearly, though, there's an option to trade above these at your own risk if you assess your customer's risk to be different. Often these credit limits are based on a percentage of the customer's financial net worth, for example 10% as a benchmark for setting initial credit limits, and supported by a cash flow to service this. Clearly, subsequent good payment history would then support incremental increases in that credit limit. Payment terms are the next area, and setting these to ensure they support the repayment of the credit limit is key, i.e. 30 days net or end of month net, usually where higher margin work is offered in return for extended payment terms or a higher risk. One interesting point is the credit limit increase forms. It's an important tool to support the sales team and simply seeks to capture and be proactive in understanding your customers' needs as your trading with them grows. It allows them the ability to trade while still keeping control in terms of credit limits, with the premise that higher margin sales are needed to justify higher credit risk. Having set the limits, it's then important to monitor how your customers are using their credit. And the following factors are often key. Firstly, credit monitoring. Putting a watch on companies' house filings for your customer will ensure that if any actions take place, like your new legal charges, filing or change of directors, you're notified. Equally, monitoring the Gazette will ensure you're notified of either your customers' insolvencies or their customers. And this will provide you with a list of creditors to check if your customer's ability to pay will be impacted by their customer. Second factor is regular communication. Talking with your branch teams on a regular basis about each customer will highlight very quickly any changes in their behaviour. If they're quiet, so they may have difficulty paying, if they've got new jobs starting, in which case you've got an opportunity to review credit limits ahead for the branch so they can use that as part of winning the work. Next factor is payment history. Most obvious and the most tangible is cash is king. Prompt payment history support credit increases as well as poor payment history signifying the need to look closer. And one of the other factors often overlooked is surplus credit insurance. Regularly checking credit insurance utilisation is paramount, whether to inform branches to proactively sell as there is insurance on those customers, or proactively reducing where it's not utilised in terms of your premium. Collecting customers' payments on time sounds obvious, but doing the basics well can have a significant impact on the amount of money collected on time. Electronic invoicing and proof of delivery is one of the first areas. Sending invoices electronically with associated PODs allows your customers to see what was purchased when and query ahead of time. Using electronic signature capture, both in branch on trade counters and also on your trucks and vans, allows the proof of delivery to be easily retrieved, automatically sent with invoices or statements, or when queried by email. In a similar vein, electronic statements are key and make it easier, clearer. You make these in terms of regarding what needs to be paid, the more likely you are to get paid. Dunning cycles, usually in 3 or 4 stages, refer to the letters that are sent to your customers and usually comprise an initial reminder shortly after the due date to confirm receipt and solicit any queries. First reminder, typically 15-13 days after. Second, 30 to 60 days. And the final notice, typically 90 days. Timescales often depend on whether they're sole traders or companies. To support these call cycles and cash collection targets, key. Setting and tracking clear call cycles and using a CRM to record your notes, and setting cash collection targets for your credit controllers will all help. One other area is about automated reconciliation, which is arguably the most time-consuming part of the process. And by automating or using AI for the reconciliations of payments to invoices and accounts, more time can be spent by your invaluable team on higher value tasks like speaking to customers, for instance. Managing the credit risk of late payments and how to mitigate that is key. And some of the considerations are around payment methods, so understanding your customer base and the way each of them want to pay. Sometimes type of card can make all the difference between payment and indeed retaining a customer. Looking on a case-by-case basis at an extra percentage fee maybe versus actually receiving payment by that card. And often the extra margin you can make will make all the difference. Using new technology too with regard to payment methods, things like payment links can significantly benefit both merchants and customers, allowing them the ability to pay by mobile on site. Using a secure link will increase both the likelihood of being paid as well as reducing your cost to serve. Incentives are another. Offering discounts for early payment, often called settlement discounts, can be attractive to some customers. And the more customer-centric your credit management team are, the more opportunities there are to understand the barriers to late payment. In the event payment plans are needed, receiving some payments regularly is often better than no payment at all. Understanding why customers cannot pay and their ability to pay are prerequisites to determine the feasibility of a payment plan, along with the impact on credit insurance. In those situations, as in others, communication is key. An invoice dispute resolution. The earlier the disputed invoices are identified, the earlier resolution to avoid late payment can be undertaken. Managing the recovery proceedings when past due. Often, despite following collection processes, customers may still not have paid. There are several considerations then. First is the formal letter before action, or LBA. Having allowed sufficient time between letters, the LBA will inform your customer of your intention to issue court proceedings to recover the outstanding amount. Ensure your letters are compliant and timescales to pay are correct. Debt collection agents are an option within this process to outsource debt collection to a third party to act on your behalf. Reputationally though, it's important to understand how they operate. Options if customers still do not pay are either court action, and at this point it's important to understand if your customer actually has the funds to pay or not. Simple cost versus benefit analysis is well worth the time to understand. And if debt's less than 10k, going to the less expensive small claims court is an option. If thought worthwhile, a claim can be issued to court and court proceedings commenced. In the event of enforcement, retention of title and charging orders over goods and property come into play. In the event of the threat of insolvency, proceedings is often the last option and often prompts payment. But beware that in the event of liquidation, the likelihood of recovery of the debt is often less certain too. We hope you found this webinar of benefit, and if you have any questions, please don't hesitate to contact us directly or connect with us online to follow the work we are doing and the best practices and ideas we share, should you need our help in the future. Thank you very much for listening.